Hey guys, it's Sasha. Inflation has hit unprecedented levels and is double what it was in April last year. It is unclear to what extent the rise in inflation is caused by the huge increases in money supply or the rising energy costs throughout the world. Russia has invaded its neighbor country in a war that is universally condemned the world over. The war is not going to plan and Russia is struggling to maintain control of the invaded territory. And of course, Russia blames the United States for instigating the war and causing it in the first place. Oil prices have doubled in the last year following a global supply crisis after Russia and Iran were heavily sanctioned. Interestingly, the total supply of oil around the world hasn't changed much. The crisis was mainly caused by a shift in which countries buy oil from where and the rerouting of trade routes. The UK has just got a brand new female prime minister who is making drastic changes and implementing massive tax cuts. Central banks around the world are sharply increasing rates, which is sending the stock market into a panic. And the stock market just fell by over 10% in the space of 2 weeks. Sound familiar? The date is March 1980, and the similarities to today are eerie. The world was panicking ahead of a looming recession that was almost certain as the Fed and the central banks around the world struggled to contain runaway inflation. The 1979 energy crisis triggered the sanctions on Iran and was compounded when the USSR invaded Afghanistan on the 24th of December 1979, with the Soviet Union being the largest oil producer in 1980. There were two schools of thought at the time. One said that inflation is not systemic. It is caused by the energy crisis, the geopolitical situation, supply chain issues, and those issues were temporary. So the central bank decisions to hike interest rates were unwarranted, because of course inflation would go down all by itself as those causes resolved. The other side, though, said that inflation is now being driven by the inflation wage spiral that could have originally been triggered by these causes, but is no longer being fueled by them, and is now running all by itself as the cost of living crisis causes a huge pressure on employees demanding massive wages. Those increasing wages are causing the cost of the goods and services produced by those wages to go up, and so on in a vicious cycle. And even the Fed didn't seem to know which side of the fence they sat on. As inflation smashed through the 10% barrier, the Fed increased already high interest rates. The rate went from 10% to 20% in the space of just 5 months. The sudden shock to the system caused inflation to stop growing. It capped out at 14.8% in March 1980, the same month that the Fed rates shot up. There was a gargantuan amount of pressure on the Fed at the time. A lot of people were saying that they are destroying the economy needlessly, and the rates came down about as quickly as they went up, back to around 10%. And inflation dropped a bit from the shock therapy that happened, but nowhere near enough. And in October 1980, it started going back up. It became apparent that the mechanics of the wage inflation spiral were taking hold and could not just be stopped by the underlying issues being resolved. The easing of the initial causes that many analysts said were the only reason inflation was high did nothing to bring the numbers down. So Paul Volcker, who was the Fed chairman at the time, had to take drastic action and increase rates again, starting from October back to that 20% level. And inflation began going down again. Basic economic principles worked. If interest rates are higher than the level of inflation, borrowing money becomes prohibitively expensive as interest rates soar, and that causes a massive downward pressure on spending. You also get hefty returns for keeping your money in the bank, so saving also becomes a good idea. So demand gets smashed and the level of inflation drops. So in January 1981, inflation dropped down to 11.8%, and things looked like they were going in the right direction. People were patting themselves on the back, and under immense pressure, the Fed stepped on the same rake again and started reducing rates too early, back to below 14% as early as March. And inflation quickly stopped falling as that happened and flatlined, despite fears of an imminent recession and unemployment increasing. So Paul Volcker pushed rates back to 20% for the third time at the end of April and kept them there through to August. And it turned out that it was the right move because inflation stopped flatlining and started going up again, hitting that 10% mark in July. The US entered a recession formally in Q3 of that year, and unemployment started increasing and went from 7 to 10% in the course of 12 months. Reduced output and fast reducing real rates of pay began destroying demand. The Fed was much more cautious the third time around in dropping rates and kept the rates high for another year, despite a public outcry. And they only lifted off this policy gradually from August 1982, and this time they kept the rates high enough, long enough, that the inflation came down all the way to 5% by September. But here is where it gets even more interesting, because here is a chart of the S&P 500 index over the same period. And you can see that there was a blip in March 1980, the month I started this video with. The stock market was in decline because of fear and uncertainty, and it dropped massively in the space of just 2 weeks, but the Fed started taking considerably more decisive action in the same month, in March 1980. And it appeared that the Fed was doing everything right all the way from there until November 1980, which is the exact point that the Fed realized that they made a mistake in starting to lower rates too early. Inflation stopped falling, panic spread again, and the S&P 500 continued falling all the way from November 1980 to July 1982. The moment inflation was finally beaten and rates started coming back down. And this is where it gets even more interesting, because we only really have one episode in modern economic history where rates went sky high to learn from. So we only have one set of data and only one example to learn from. And the question is, have we learned the right lesson? At the moment, everyone from Cathie Wood to Elon Musk is saying that the root causes of inflation are all busy solving themselves. Energy prices are coming down in the last few weeks, commodity prices in general are falling massively across the board, supply chains are finally resolving and improving after the chaos that was caused by COVID, and there are increasing calls for the Fed to stop hiking rates because, well, you know, inflation is going to go away all by itself once these root causes resolve themselves. But look a bit deeper under the skin, and you can see that the food prices are increasing at record levels, with basic supermarket shopping costing 13.5% more in August than it did in August last year, well above inflation despite gas and oil prices falling. Rent is still going up 10% year on year after already going up 10% year on year last year. The big question here is, does a sharp increase in basic living costs, things like food and shelter, mean that the demand is going to self-destruct anyway, because people simply don't have enough money to spend on other things? Or is it a sign that the currency inflation is simply getting out of control? There has been a lot of criticism recently saying that the Fed just doesn't get it. Some people have said that the Fed is using lagging indicators and that the decision making is not using robust data sources, because the data sources are saying the root causes of inflation are going away and hence inflation is going to follow suit. And the truth is, we don't know, because we only have one anecdotal example of this situation happening in the past. And although there are a lot of similarities, our world today is incredibly different to the world of 1980. But in the last month, the Fed has suddenly changed. The rhetoric used in public speeches has changed. The narrative around inflation, the causes, and the future outlook has also changed. And although there is a lot of dirt being thrown at the Fed, you could argue that the Fed is still massively underestimating how bad things are or how bad things could get. The rate has just gone up another 0.75% to 3.25%. And remember that this rate was at 0.25% just a few months ago earlier this year. I know, that seems like a lifetime ago now. But what spooked the market last week was the worsening outlook that Jerome Powell presented. Because you can see that the committee members thought that the highest the rates would go in 2023 next year would be 3.8% at their last meeting in June. And at the September meeting, they now think the rate will have to go to 4.6% on average. And you can see that there isn't much of a distribution between their opinions. Every member of the Fed committee is singing from the same hymn sheet. They all think that the rate will hit somewhere between 4.3 and 4.9% next year, with one optimist outlier. But remember that they have all just revised their estimate upwards by 0.8% since the last meeting. And the consistency here should be worrying to anyone reading this report, because it smells a lot like the Federal Open Market Committee is too busy playing politics instead of their job. Still, how is it that they all realized in the space of 3 months that they were wildly wrong about inflation, but they all have a ridiculously narrow new consensus on what the rate next year will be without any real difference in opinion? It couldn't possibly be because they don't want to rock the boat too much. Remember, inflation is at 8.3%. 5% above where the current rate is. And the only reason it didn't push towards 10% or higher in July and August is because energy costs have collapsed drastically. And those dropping energy costs have artificially pulled inflation numbers down. Right now, the stock market is reacting negatively to all of this, and we have seen a big drop as a result. And the overwhelming consensus among financial analysts is that this is the start of the real crash that is going to go down a whole lot further. But there is one really interesting lesson to learn from the 1980 example. The stock market didn't go down because of inflation. The stock market did not even go down because of rate hikes. In fact, the stock market seemed to be affected a whole lot more by uncertainty and panic. In fact, when the rates were going up very fast and the Fed seemed to be in control, the stock market rallied. When the Fed started lowering rates but still seemed in control, the stock market rallied even more. The S&P 500 gained 40% from March 1980 to November 1980, one of the most incredible bull runs in history. And the stock market started tanking when uncertainty returned and it looked like the Fed made a mistake in lowering rates too early. And even as the recession was deepening, things were looking bad, people were losing jobs, the market then gained 60% in 9 months from July 1982 after the inflation was finally under control. And the question is, as the Fed is taking more decisive action and increasing rates more aggressively to tackle inflation, will the sentiment change just as quickly today? There is a lot of doom and gloom out there at the moment. Everyone is saying everything is about to collapse, the end of the world is upon us. But if we see inflation growth slow down in the next few quarters as the rates continue going up and the quantitative tightening taking effect, and the market grows more confident that it is just a matter of time before inflation is finally killed off and put under control by the Fed, could we get the exact opposite effect of what most analysts and YouTubers are certain will happen? Could we get our own 40% or 60% bull run in the stock market in under a year, despite high inflation, despite increasing Fed rates, despite the looming recession? I don't know, but it's an interesting question, right?